Thanks for clicking! It could be time to lock in your variable rate mortgage. This according to a new report coming from the Financial Post. Yeah, and this is a big change coming from the Financial Post, which has written multiple articles over the past year, goading borrowers into taking on that additional risk. But this article from Rob McClister actually considers both sides of the coin. It's well researched, well thought out, with only a tinge of unearned arrogance.
But that's the best I can do.
But it's a question that's coming up a lot as of late. And given, as we'll see, continual sticky inflation pressures, rising bond yields, tariff uncertainty, the apparent resilience of the economy, and continual predictions that the Bank of Canada is done cutting interest rates, it's definitely a question worthwhile to ask. So what I want to do today is go over those arguments in favor of locking in, take a look at those counter-arguments, and then discuss what it all actually means. We are eagerly awaiting the Bank of Canada's next interest rate announcement, set to be released next week with a press conference held thereafter, and we'll obviously have an update out on that announcement on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, let's get into variable rate mortgages. On to locking in your variable rate mortgage. McClister starts out quite rightly with clear signs that it's time to lock in. Mainly, if having a variable is wrecking your nerves or your family budget, could not take an increase. And McClister is 100% correct. If it's bugging you bearing the burden of potentially higher rates, which isn't exactly out of the realm of possibility, with Scotiabank recently noting the bank may have dropped rates too far too fast, then it might be time to calm those nerves and lock in. Further, if it's worrying you having a variable rate, then there's probably a good reason for that, in that if interest rates went up, it could lead to undue financial hardship.
And you'll lose.
Yeah, and I think that's part of the problem. All too often, the industry, mortgage brokers, banks, and definitely the author in question present variable rates as what winners do. And those who don't take that risk are too scared and are going to miss out. But for most people at least, this is not a game. They're not investors. Beating their neighbor out by 0.5% isn't going to change their life trajectory. But having to pay 0.5% higher because something unexpected happened and the bank had to raise rates, that very much could. And if you're at that point, then it might be worth locking into that safe bet. But it's not even that ludicrous of a bet. The United States is already starting to see the inflationary impact of the tariffs, with the Council on Foreign Relations noting the tariff inflation has come home to roost, the Federal Reserve finding that firms are passing price increases onto consumers, and Stats Canada noting that even Canada is already starting to see the price increases from tariffs in footwear and clothing. Meanwhile, some have argued that tariff-led inflation is indeed going to be transitory, as it's a one-time increase in the price level.
Only for a little while.
With that said, others are noting that many households could be once bitten, twice shy. Meaning, if households start to think that prices are going to go up and that it's not transitory, not an unreasonable assumption after getting completely hosed by the powers that be that 100% knew better, if they start thinking prices are heading up, they're going to buy now, they're going to demand wage increases, which could become a self-fulfilling prophecy. We all saw the predictable strikes that followed the 2021 and 2022 price increases. Does anyone really think that workers, absent a massive recession, are just going to accept this one-time decrease to their purchasing power? The concern over a wage price spiral was so salient that the central bank, the Bank of Canada, actually undertook a study on it in 2024, stressing the importance of central bank credibility when prices are rising.
Can't be. These can't be right.
But the point is that the worries that borrowers are having are not unfounded. And there is a big disagreement amongst the experts as the extent to which these tariffs are going to be inflationary. And if the experts don't know, that means you don't know, that means I don't know, the guy on TikTok who may or may not have a GED doesn't know, which means if your budget is at that point where the fear of a rate hike is keeping you up at night, then it might be worth locking into safety. It's free to do so, just call your lender and they'll lock it in for you.
Don't do something without talking to me.
On that, one of the reasons that banks, brokers, the real estate industry are so flippant with other people's money is that when you take on a variable rate mortgage, they have a potential second kick at the can. Instead of simply just locking in your variable rate mortgage, pay that 3 months penalty, maybe you'll want to take out a new mortgage, refinance, and pay off some debts.
I need you to give me some money.
But the point is that you don't have to re-qualify, you don't have to take out a whole new mortgage if you just want to lock into a fixed rate. Just call your mortgage lender, it takes like 10 minutes. But what about the other side? What's the argument for sticking with that variable rate? Well, McClister puts it, if you're mentally and financially equipped to handle rate volatility, then it might be worth it. Mentally equipped. Regardless though, despite the arrogance, he's not wrong. All things being equal, chances are we will eventually see more cuts during this cycle. Despite the 1 month's economic headlines with the renewal wave coming up, not to mention all of this tariff uncertainty and the tariffs themselves, chances are the economy is going to take a beating over the next couple of months, couple of years ahead. Further, if you do plan on breaking your mortgage at some point soon, then it's probably best to hold on to that variable rate as well. If you have a variable rate and you break your mortgage, it's only 3 months interest. However, if you have a fixed rate and you do break it mid-term, there is a potential for much higher penalties. So, in McClister's article, the choice between variable and fixed is now, as it always should have been, the choice as to whether or not you can handle the swings. If your budget can take higher payments, and you're okay with that, then maybe it's worth taking the risk on variable. But if you're already tight, then it might be worth fixing. But I think the real thrust of this article, the most telling, is that McClister really isn't arguing, he really isn't trying to predict where things are going to play out. He notes that inflation is sticky, the policy rate is around neutral, government spending is running wild, tariffs pose an inflationary hazard, yet the economy continues to hold, markets still expect a further cut, and fixed rates, while low, are starting to rise. Meaning McClister knows he has no idea where things are going. Meaning your budget, not the experts who have absolutely zero clue, should be the deciding factor. Personally, I think the Bank of Canada is going to have to cut rates eventually. Maybe not over the next few months, but eventually I can see rates going down from here. Between tariff uncertainty and the mortgage renewal wave, I think the economy has some very tough days ahead of it. I think the bank is going to hold off on cuts as long as they can in the hopes that if they deliver a big cut, say 50 basis points, they can get more gas out of that from the additional buzz than they would from, say, 2 25 basis point cuts consecutively. 2 consecutive 25 basis point cuts. But I follow this stuff every day, and the best that I can give you is gut feeling, as these are unprecedented times. We don't even know as of yet what is going to be done to the economies. We don't know as of yet what the tariff rates are going to be, let alone how the economies are going to react. As such, if your variable rate is keeping you up at night, then it might be time to lock in. And you can look at the potential extra cost as the cost of insurance. Insurance against keeping you up at night, insurance against future hikes. You don't get mad when you pay your house insurance and your house doesn't burn down. So if we do end up seeing lower rates and you've already locked in, that just means you paid for insurance. It's not a game, it's not a race, it's your shelter. I spoke to a lot of people who were being kept up at night post-2022, and I can tell you they were far more upset at their massive rate increases, at their massive payment increases, than they would have been had they found out their neighbor had a better rate than them. With all that said, we will obviously continue to track Canada's mortgage market on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, thanks so much for watching.